Jesus for giving us the ability. I bless you because you're our Lord, you are the keeper, you're the maker, you are everything. You are the one who is going to see us through this meeting today. And I pray that you continue to guide all of us as we strive to make it happen in our different communities. Thank you, Jesus. In Jesus' name we've prayed. Amen. Thank you, Ivan. Thank you, Alino. Thank you, Lisa. Thank you for all those who are on the platform. Regardless of us, what's happening, we made it, and I'm glad we can actually talk about this. So today, how to access capital. And again, as I usually say, I have a couple of platforms. I'm on Instagram, I'm on YouTube, I'm on Facebook. So basically, you will see me going from screen to screen. And another thing is that I also have my computer to be able to guide our conversation. So today, how to access capital. How do I actually raise money for my business? How do I... So many of us have this great idea, and we've said it so many times. We've said here that the biggest thing about being anywhere in the world, and mostly for those who are in America, is that we have access to capital. We have access to the largest capital market in the world. And when you have access to the largest capital market, you want to make sure you understand the ways to access this capital. If you understand how to access this capital, then you can basically make a strategy to accessing the capital you need to be able to run your business. So our aim today is to understand what is even a business, because many people come, they want to access capital. Some want to buy homes, some want to buy their personal assets. That's not a business. Today we are focusing on what's a business. So you have this incredible idea, or you already started a business and it's been doing well, but you want to scale it. You want to take it to the next level. And what you need is capital. And because you need capital, you're supposed to look at the ways that you can access that capital. Again, one of the hardest things to do in business is to access capital. So we're talking about that today. So what are the options that are available for me as an investor, as an investor? But first of all, as a businessman, I have a business. How am I going to make it happen? What are the options that are available for me? There are so many capital raising options and they all depend on the type of business you do. There are some businesses that are very capital intensive. There are some that are not capital intensive at all, but they are great businesses. They are very profitable, but they are not capital intensive. And the method, the access, the capital that you need for these different types of capital from these different types of businesses are completely different. I'll just give you a rundown of maybe 3 different capital raising options. But before that, we'll look at what you need to do yourself to be able to access some of these capital structures. I mean, I've had people come to me with an idea. When you have an idea, you don't have a business. You only have a business when you have started transacting. A business exists when there is a service or a product, and that product has been exchanged for capital, for value. And that value can be transformed, it can be convertible into cash. That is when you say you have a business. So when somebody comes to me with an idea, at times I tell, okay, if it's an idea that you need to go and sit and then you build a business plan so that you can see how you raise capital. And some businesses don't even need you to raise capital. You just need to start doing the business. So those are the things we're talking about here. So there are some key questions that I'm going to talk about today. And these are the questions that you need to ask yourself before you even start talking about starting a business. Do I really need to raise money? Is one of those key questions. There are some businesses that you don't really need to raise money to do that business. You already can run the business based on your personal funding, or you can run the business yourself. You basically don't need capital for the business because you have to be able to distinguish it. The other thing is, how will you use the money? Even if you were to access the capital, how am I going to use the money? These questions, as I say them, they are very important for you and also for the investor. So before you even get in front of an investor, you have to ask yourself these questions, because the investor is going to ask you those questions. If it's a bank, the bank is going to ask you those questions. Those are some of the questions that you need to prepare before you even start thinking about accessing capital. Because if any investor asks you a question, if they ask you some of these questions and you basically mumble around them, then it tells them that you're not prepared. You're not ready for what you need to do. Most of investors we have are sharks. And what they are interested in is the return on capital, return on their investment. When they put an investment, they're looking for 3, 4, 5 times return on that investment. And they need somebody who is specific, who understands what he's doing and things like that. That's why we're talking about these questions. Another thing is, can you even do the business? Can you run that business even without that? The reason this one becomes very important, without me getting this investment, this capital I'm looking for, am I able to even run this business? This is very important to an investor. If you came to an investor and you asked him that, and you told him that, look, I have this idea, this is how I've done it, I've had the business plan, I've done all my research, I've done everything, and the details are there. I need this amount of money, I need 500,000, I need 200,000, I need $1 million. I need this money to be able to do this, and this. The first thing that you want to show is that you want to show, when you make the investor understand that regardless of you getting this money, this business is going to happen. They know that you are not expendable. You are a guy, you are going to get that business running regardless of whether they invest in the business or not. They become more interested in that. Another thing is, most people, and this is very important, when you want to stand in front of an investor, you have to ask yourself the questions that an investor, put yourself in the shoes of an investor and ask yourself, if I were the investor, will I invest in this business? You have an idea, you have something that you've already developed. Now you need someone to put his money in there. So the first question you should be able to answer is, if I were sitting in this person's shoe, will I invest in this business? Is the return on this investment high enough, good enough for me to put my money in? If the answer is yes, then someone else will be able to say yes to that question. Another one, which is very important, and I'll tell you why this is important, is the detailed plan. And this is what I see every day. Most people come to you, they tell you, oh guy, I have this business. I'm about to start a business. And you tell them, what is the business all about? They tell you, they give you 1, 2, 3 things about the business. They don't have any detail about that business. They don't know, for example, how much you're going to sell for, what is their target client, what is the target market, what is the target. They have not broken the market. They have not done a detailed plan of the operations, of the financing, on who is going to be what is needed for this thing to work, and especially what is competition doing? Who is the competition out there? How am I going to tackle competition and things like that? If you don't have a detailed plan for your business, for example, let me tell you something. You come to an investor, you're looking for maybe $1 million, or maybe $500,000, or maybe even $100,000, and then that investor tells you, okay, I'm gonna give you asked me $500,000, I'm gonna give you $50,000. So with $50,000, what are you going to do? You need to be able to tell him exactly what you will do with the $50,000. I am going to build a prototype. I am going to build, because that is not enough for me to do my business, I'm going to do that prototype that I'm going to take to this investor to get the remaining part of the capital. You have to know exactly that, and you cannot know that if you've not done a clear business plan with clear priorities of what you're going to do first, what you're going to do second, in order to get to where you want to go. You have to know one thing as well. Research about the industry. I mean, most people just go into a business, and I say that into my community. People just tell you, okay, I want to buy a property to do rental. I want to have a rental property. I want to do Airbnb. I want to do, maybe you want to do car rental. You don't know the details about the market. You have not done your research. Who are those who are the players in that market you're dealing with? If you don't know the players in the market and you don't have a distinguishing factor, what distinguishes you from the other players in that market? What is going to make your product more competitive? And again, it must not be that the difference is big. It might just be the culture that you're going to set in the business. But as long as you don't understand what is happening with the industry altogether, there is every likelihood that you're going into a gamble. You don't know exactly what you're going to get into. So it's important you know enough. You have enough research about the market. I said about business plan, I cannot emphasize enough on business plan, because if you do a business plan, most of these things we're talking about will be answered within that business plan. Who is your ideal investor? There are some people who need to go to a traditional bank to get that investment. There are some people who need to look inwardly and get their investment. There are some people who need to go to your family and get the investment because of your values, because of what you're trying to achieve. For example, if you don't need control from a third party, when somebody puts his money in your business, there is every likelihood that he's going to control you, especially from the banking sector in the United States, from the SB, whoever he is. He's going to try to control because he wants to make sure that he's going to get that return on his investment. And he's going to meet those targets that he has set for himself, because they too, they have their own plans. When they put the money out, money that is being given to you as a loan is actually what someone else sells. So that is part of his own business plan, and he understands, he knows exactly what he wants from that return. So business planning is so important. Knowing your ideal investor, is it family, is it a venture capitalist, is it your bank, etc. And if you're doing an international business, are you going to go Exim? Are you going to talk to Exim Bank or whatever? You want to know that very clearly. You want to dilute control. Are you ready to dilute control? I just talked about it. Are you ready to dilute control? Dilute control is simply what? It means that when somebody, if you, for example, raise capital by issuing shares, when you issue stocks out there, and then you have more people into the equity, into capital of your business, basically your control is diminished because you have to share control with other people. So basically you want to ask yourself, am I willing to relinquish control? Some of us who are in franchises, you relinquish control by getting into a franchise because the franchisor is going to ask you questions. He's going to put rules, he's going to do things that if you are not somebody who is easily controllable, who can act, who is not easily controllable, but somebody who can follow rules, then it might be difficult for you to get access to certain types of capital. So it's important you understand that. Another thing is, what are you being accountable to others? We've talked about that. What is your overall goal? This is so important. There are some people who go into business to build and sell. You build the business and then you sell it. Some people go into the business to build a lasting wealth structure for their family, to build a dynasty for their family, to build something that is going to be there to support individuals out there. That is also something you want. That is something you want to think about. What is your overall goal? What are you trying to achieve? Because that determines the way you structure your business. And even investors. There are some investors who are interested only in companies that are there for the long term. They are not interested in companies that are there to build for 5 years and then sell it. They are not there to scale and then sell. So you want to know that, because investors are also interested in answering those questions. Now, having said all of this, and there are so many other questions, and I'll tell you, I have templates for business plans. If you want to get templates for your business plans, talk to me. Come to our firm. We'll give you templates to build your business plan, because there is no business, no business out there that is going to strive if you don't have a proper business plan. If you don't have a business plan that is detailed. And business plan is not difficult, my guys. It is not difficult. There are already templates. There are things that are there for you to look. And you have to take some time. If your business is going to generate revenue, if you're going to meet those objectives that you set for yourself, it is only normal for you to sit down and study the market, have your niche market, understand what is your price, what are the competitors selling for, and what is your target price, what is your target customer, where are you going to source your raw materials. All those things are clearly stated in a business plan. And then you want to know what are your expected revenue for the month, for the quarter, for half a year, for the year, for 3 years, for 5 years, and even 10 years. Once you are that specific, then you have a basis to be able to analyze your income. It is so important to analyze performance. There is no analysis of performance if you don't have a basis in the form of a business plan. So that is so important. So what are the different methods of raising capital? I'm going to talk about 2 main methods of raising capital. And within those 2 methods, there are sub-methods of raising capital. And I talk about this because one other thing that I want you to understand is that this is a big topic. I didn't want to just take this topic and then go through it. There's a lot of ways to raise capital. I'm going to talk about the 2 most common ones. And then after that, there is another series to talk about the other methods. There are so many methods of raising capital. But because I'm talking to small businesses, small entrepreneurs, people who are startups, I'm going to talk about what is interesting to you. Equity, debt financing, all those things, we'll talk about them. In subsequent courses, we'll talk about more about how those work and how do you structure them. Number 1, the most important way, one of the most important ways of raising capital is bootstrapping. Bootstrapping is one of the most important ways. And again, what is bootstrapping? Bootstrapping simply means using your own personal funds to build your business. So if you're in a partnership, you guys bring your money together and then you invest in your business. As long as you're not using third-party sources of revenue to build your business, then you're using bootstrapping. You bring the partners come together, they bring their funds together, and then they invest in the business, and then they grow the business without having debt as being a principal method of investment in that company, of investment into that company. So bootstrapping, number 1. And other ways of bootstrapping, you use your own money. I mean, some of you who've been listening to, when you listen to somebody like Dave Ramsey, he talks a lot about bootstrapping, how you can build a business. And I'll give you some of the advantages of bootstrapping as well. So using your own money through savings, what you have saved over time, and using it to invest in your business is one of the key ways. Another way is self-directed IRAs. That's part of bootstrapping. Self-directed IRAs, many of us have worked for years within the corporate structure. We're in industry. We've worked for years for other people. And over these years, we have saved money in 401ks. We've saved money in IRAs, in Roth IRAs. We've saved all this money. What happens is that you can basically use that money and structure it to be able to finance your business. And I mean, there is a lot of rules around using IRA, around using this money, because all these monies, they have been kept there for your retirement. You only have access to them in most cases after 59 years, 59 and a half years. So if you are before that age and you wanted to use your retirement money, you have to see a CPA who understands. There's something that they call rollover business startups. It's called ROBS. It's a structure that is set up by the IRS, and it helps you to basically self-fund your IRA, self-fund your Roth. You structure it in a particular way and make sure, the key here is to make sure that you're not using the money. You're not taking money out and using the money prior to the time that's been set. But you are self-funding. You're not allowing a third party to be able to determine what type of activities you're funding. You're investing your own money, As long as you meet the requirements set up by the IRS, then you can build that capital, grow your income within that IRA, within that retirement money. Grow that income, tax deferred. And then you can use the money when the time comes for you to use the money. It is a very, very highly structured mechanism, but it's very important for so many people to be able to use, to be able to finance, self-finance. So with self-directed IRAs, you can use your self-directed Roth, you can use your, you can self-direct your Roth, your traditional IRA, your 401ks, all those monies that you've kept aside by law for retirement. You can self-direct them, and that's part of bootstrapping as well. Another very important one is HELOC, and what is called refinance. You have a home, you have a property, you can basically go and refinance it, and this is, you get money back into that home and invest into your business. So I mean, they call it HELOC. You take some money out. HELOC, how do you call it? Home equity line of credit. So you're getting money out of your home, and then you can take money, you can go and refinance your home, get money there, and then you can put in your business. So these are all bootstrapping methods that don't require you to go looking for funding through other methods to self-fund your own business. That's number one. The biggest advantage of bootstrapping is that it allows you to be able to grow and take advantage of the benefits of your business. You don't get control. And then you basically, when you want to get third party, if you decided at some point to get debt equity, you have a lot of equity in your home, you have a lot of equity in your business, that you can basically go out there to any other source of investment and then easily get access to money, because you have bootstrapped for so many years and you've built a lot of equity into that business, and there is no debt in the business. So now you have a lot of power to be able to access other people's money. That's it. The second one I'm going to talk about is about traditional loan from your bank or the SBA. For small businesses, I always encourage small businesses to go the SBA route, because the SBA, as long as you meet their requirements, they are not as sharky as traditional investors. Most investors in the United States are sharks. They are sharks. They are going to rob you. They are going to try to get every return on their capital, on their investment. But with the SBA, it's more of the government. So you can, a little bit there, they can listen to you. Traditional, the key things that will be required of you when you go for traditional loans is, number one, they want to make sure that you have a steady source of income. It's like buying your home. You're looking, remember what I told you in one of my, and I keep saying this. If you are an individual who you are not a business, you haven't grown a business yet, you don't have any business credit. It is you as an individual, yourself, who is your own credit. You are going to be the credit to that business. Your personal credit is going to be very important. So you have steady source of income. You are able to access capital because you have a steady source of income, either coming through the business or coming through other sources. Another thing is you must have 70 plus credit score to be able to get access to, 700 plus credit score to be able to get access to the capital. Another one, you must have equity in your home. If you're going to do HELOC, you cannot do HELOC without having equity in your home. Industry experience is always very, very important. You cannot be a nurse and then you want to open an accounting consulting firm and then you're looking for money. It's going to be hard for you to get it. You might still get it, but it's harder. One of the things they are looking for is your industry experience. So when you are a nurse and you're opening a group home, that makes sense to an investor. He understands that you are within the line of business that you have been doing. When you are a nurse and then you're opening a clinic, or you are maybe a doctor, you're opening a clinic or things like that, those are the things you are within your sector. You are a lawyer, you're opening a firm. You are a CPA, you're opening a firm. That makes sense. So your industry experience really matters. You're a real estate person and you're trying to open in real estate, you're doing you're trying to buy some property to continue renting out. Even if you're not in real estate. Again, those are the things. Industry experience, it really matters. And then on top of this, regardless of where you want to go look for money, you have to do a proper business plan. A business plan is always a requirement, folks. It's always a requirement, unless you're not looking for large sums of money. If you're looking for smaller sums of money, your credit can make you have access to $10,000. Your credit can make you have access to $50,000. Your credit can make you have access to $100,000. But beyond that, you have to show that you have you have a proper business plan. And in most cases, they will even ask you for 2 years of your tax returns. Because your tax returns, what do you need? These banks, they want to see, when they say a steady flow of income, they can see that through a tax return. So that is why I say tax returns are always a strategic tool, because you use them to access that capital. So I'll give you a couple of different methods of raising capital through the SBA, for example. If you went to the SBA, there is what they call 7A loans. 7A loans, you get up to $5 million for small businesses. Small businesses, you can get access to up to $5 million from the SBA. Again, those things that we talked about there, you have a steady flow of income, you have a business plan, you have a credit score that is over a certain number, you have your credit is proper. All those items, they come into play, but there are templates. If you go to the SBA website, they are very clear templates. And if you need us to help you to access these loans, we are here to be able to help you access these loans. Another one is 504 loans. 504 loans are long-term loans. You want to invest in some sort of fixed-term, long-term investment. You want to buy property. They can give you up to $5 million to do that. Again, you want to do major assets. You want to invest in major fixed assets. There's 504 loans that are available for that. You get up to $5 million as well. Then there are micro loans. They do this through the traditional banking system. Micro loans that are being funded by the SBA through the traditional banking system, they'll give you up to $50,000. So if you're a small startup, you wanted to start, that is where to go to try to get access to these micro loans. Then there are what the SBA also does, which is incredibly important, is that they are able to match you. They are able to do what they call lender match programs. So what it means is that it provides you the required guarantee so that you can be able to, for example, sell. If you wanted to sell abroad, they work together with banks like the Exim Bank. They provide the required guarantees so that you can get those loans that you can get to sell abroad. You maybe have a buyer who is in the United Kingdom. That buyer in the United Kingdom, because it's not in the United States, these banks, or maybe they help give credit assurance to you so that you can sell internationally. So they are lender match programs. And what do they basically do? They'll give you the insurance. They insure those products for you because they have done their due diligence through other financial institutions like the Exim Bank and other associated banks. They know that the third party is going to be able to pay. So they encourage your business to be able to do international business because they give you the insurance that covers the sales to that third party. So these are some of the things that you need to know about. We can talk about these things forever, folks. There are so many things we can talk about. For example, again, we can talk about raising capital through debt. Debt, we've just talked about debt, but there are so many ways of raising capital through debt. You can issue shares to the general public. You can go public. Those are different ways. And we are going to talk about that in the next session. Today, it was all about telling you, giving you what you need to prepare in order to have access to funding. What are the things that you personally, as a businessman, you want to get ready in order to access funds through a third party? And also we wanted to talk about the different sources of funding that are out there. When we talk about crowdfunding, well, not crowdfunding, when we talk about bootstrapping, in as much as it only brings money out of you, you are the one creating money. There are so many people who don't even know that they can get money out of the assets they own. There are so many people who don't even know that, who don't even understand how to bring family members together to be able to come together into a partnership and build something. Or friends and families. Those are some of the things that you use through bootstrapping. But again, bootstrapping is about using your own money without having to go into any debt to finance a business. And there's so many businesses you can do that way. Then the other option is using traditional banking system. Remember, a few years ago, that system was such an easy system. Getting money from the SBA was very easy. Getting money from the local banking system was so very easy. Then, when we had the financial crisis, they realized that most of the people who had taken loans were not credit worthy. There were so many people to whom they had given credit that they didn't qualify, and that is why most of the credit became bad credit and they had to write them off, and that was a big crash. So since then, they have improved, they have done a lot to try to reduce the amount of people. That's why credit becomes so important. That's why background checks become so important. That is why your steady source of revenue becomes more important. And I know that 99% of us who are on this program, who are in this country, who are even in Africa, we have met some of these criteria. We just don't know how to do this. And the most important thing, one of the most important things, is having a business plan. Putting a proper structured business plan in place that allows you to do that. And to do that, we are here to help you. We can help you build a business plan. We can give you business plan templates that will help you build your own business plan. And for that, we are going to, you can contact our office and we'll give you access to those business plan templates for you to be able to build your business. There is no business that is successful even if the investor doesn't ask for a business plan. You still need to be accountable to yourself as you grow your business. You need to be able to know whether you're meeting your own objectives. And to do that, you will need that business plan. It allows you to know how your business goes and to know if your business is profitable, it's meeting your self-design objectives, your vision, it's meeting your overall goals. You can only do that by putting a business plan in place. So that is what I had to talk to you about today. We'll have a second part of this discussion. We'll talk about other sources of investment. And then remember, one of the big things that I see in the industry with most of my clients is that many of these startup businesses or businesses that have already started, small businesses, they don't take care of their credit. So credit is one of the biggest things. The only way the bank or the investor knows that he's going to get his money back is by looking at your history. And your history is reported through in your credit. Your credit score is a summary of of your history. So there is this rule that we commonly talk about in credit. The 35, 30, 15, 10, 10. You have to look at that. You have to make sure that 35% of your credit score is related to what? Your payment history. Make sure you're meeting your payment history. Make sure you're doing well with your payment history. Make sure that your credit utilization is optimal. Make sure that you have a diverse range portfolio of credit, or you have different portfolios of credit. Make sure you try to build on the age of your credit for it to be positive. And then the last thing, don't run around, move around, just trying to get inquiries, to try to buy things, to get access to things. Because all of those things, they add up to your credit and they mess up your credit. You want to be at least at 700 credit score to be able to easily access capital through third parties to build your business. That is what I wanted to talk about today. And I hope you guys had something out of this lesson. The material is going to be online. This is going to be shared to all of you. It's going to be shared on the different platforms. You'll have it on Instagram. You'll have it on YouTube. You'll have it on Facebook. And then you can follow us on all these platforms because we have tons of material